I think we'll make a start. It's 9:30, isn't it? So just before I hand over to Lisa, morning to everybody that's joining. There's a lot of very familiar names and faces on there. So thanks all very much for dialing in. As you've seen on the invite, we're going to keep it to an hour. We appreciate everyone's busy. So we'll keep it to an hour as a maximum. I will just be in the background monitoring any questions. I think you're all more than familiar with Zoom by now. So there's a chat function at the bottom. So if you have any questions as we're going along, you don't need to write the whole question in, but if you have a question, just put in there that you want to ask something, and then at the relevant point, I will hand over to you, then you can ask your question. We've got Claire from marketing on as well, so Claire's going to be doing a summary at the end of this, and the slides, etc., will be sent round at the end, so you don't need to scribble away too much. So without further ado, I'll hand over to tax partner Lisa Wilson.
Thanks, Rob. Thanks all for joining us this morning. As a quick intro, I'm Lisa Wilson. I'm a partner in the tax advisory team, and I'm joined today by James Greenhalgh and Gemma McCorden-Gower, both of which are directors in our tax advisory team, the Dream Team, as we're affectionately known as. So obviously last year was very difficult for a lot of reasons. Obviously we were all battling with furlough and CBILS and just general panic. So this FD event didn't go ahead, but usually, you know, it would be for a longer period of time. We normally take up sort of the morning and have a bit more, but obviously that's not been possible this year. But hopefully next year we will back to full strength, and we can meet in person. So let me just change that slide so you can see what we're doing. This update is going to be split into 4 parts. A general update. This first bit involves me picking up on some general matters and personal tax changes that have been announced in the last year. Then James is going to pick up on a corporate tax update, and then Gemma is going to form a rearguard action and discuss Brexit, which is the gift that keeps on giving, obviously, and pick up things like MTD and other VAT issues that you need to be aware of. So let's crack on and pick up the personal. Does anybody know what this is? If you do, put your hand up. Anybody know what this is? So this is a supermassive black hole, and every time I think of public finances since February 2020, this is the picture that I have in my head. In September, the House of Commons published its coronavirus economic impact report and stated that the pandemic is likely to have cost the UK economy £340 billion in 2021 and 2022. Therefore, it's not a surprise that the government is now looking at ways to fill this super massive black hole in the public finances. Now, obviously, the most effective ways of filling the coffers really are a strong economic recovery or tax rises. Now, looking at the economy and the recovery, it appears that this is underway. If you compare the GDP from February 2020 to July of this year, GDP is only 2% below where it was pre-pandemic levels. So it seems as if we are making up some ground. However, even with this recovery, there's still obviously significant pressure on the economy. What's clear from feedback from clients is that there are continuing problems with the supply chain, pandemic, Brexit, and to a lesser degree, the Suez Canal blockage all led to a pinch in getting goods shipped around the globe. Getting freight in and out of the UK has been incredibly difficult post-Brexit, and we've been involved in assisting a number of our clients to set up overseas permanent establishments just to get goods into the EU. And there's a couple of people on this webinar who will have gone through that painful journey with me. Without PE, it seems that you're in the lap of the gods, really, when it comes to how and when you can get goods into Europe, with some authorities making up their own entry rules. But enough about the French. Let's look at how some of the changes that have already been announced. So I'll move the slide on personal tax. In September, Boris Johnson announced 2 substantial tax rises, a hike in the national insurance contributions for employee and employers, and an increase in the dividend tax. By the time these tax rises are introduced in April 2022, as well as the corporation tax rises that James is going to pick up later in the seminar, the tax burden for the UK will be the highest since the 1950s. Post-World War II, effectively, when funds were required to rebuild the nation after 5 years of war and being bombed to bits. That is the impact of the coronavirus pandemic. So let's start with the changes to national insurance. From April 2022, the rate of national insurance you will pay will change for 1 year only. The amount you contribute will increase by 1.25%, which will be spent on the NHS and social care across the UK. The aim is for the increase to raise £12 billion. And essentially it's to clear the backlog that we've got in the NHS as part of the pandemic implications. The increase in national insurance will apply to Class 1, so paid by employees, Class 4, paid by the self-employed, and then secondary Class 1, Class 1A and 1B, which obviously is paid by employers. If you are working age and earn less than the national insurance primary threshold, or the lower profits limit, as is now, you won't pay anything. Employers obviously will only pay earnings above the secondary threshold, again, same as it is at the moment. And this year does not affect those over the state pension age. So existing reliefs and allowances are still available for employers. So the levy won't apply to £4,000 employment allowance. It won't apply to reliefs for apprentices. It won't apply to newly employed veterans and new employees in free ports. From April 2022, the government will introduce, 2023, the government will introduce the new UK-wide 1.25% health and social care levy, which is obviously a brand new tax, essentially, ring-fenced exclusively for health and social care. This will obviously be based on the national insurance contributions, as it will be obviously for this first year, and it will be legislated for separately. All working adults are caught by this new levy. So it includes all those over state pension age. So that is a change, not this year, but the year after. The intention is that the levy will be temporary and will only be in place for 2 years, but we'll have to see where we are in 2 years' time, because obviously, if the backlog hasn't been cleared and they need more money, it might be extended. For you guys, this change is likely to be a pain in the bum, essentially, because obviously the administrative burden of increasing the national insurance rate for the next year and keeping out those with who are, pensioners, essentially, and then the administration burden of introducing a new levy alongside of the national insurance contributions, and then capturing those employees who are over the state age, pension state age, it's going to require additional administrative burden. So I want to now pick up on the tax rate change to dividend. So as well as the national insurance change, there's obviously now a dividend change. And I suspect that the dividend 1.25% that's been introduced is really to try and capture those individuals who might have a small salary but then take dividends to effectively remunerate themselves, which does seem rather harsh, given that these are the people that were unlikely to benefit from any of the pandemic measures that were introduced last year. But anyway, this is where we are. The rate will increase 1.25 across the board. So for basic rate taxpayers, the rate will be 8.75. For higher rate taxpayers, the rate will be 33.75. And then for additional higher rate taxpayers, it will be 39.76. Good luck remembering all of those. The £2,000 allowance is still in play. So then the increase will only be levied on amounts in excess of this. So before I move on, I just want to touch on what you may want to think about ahead of these tax rises being introduced. Obviously, consider paying bonuses ahead of the deadline to ensure that they're not caught by the NIC tax rises. Also, obviously, if the company has distributable profits, you may wish to pay them out. So consider, is the money required in the business? If it is, obviously, and you want to pay it out, you can always loan it back. Is there surplus cash that individuals might be needing over the next 3 years, and therefore it's better to take it out now and loan it back and pay slightly less tax on it. One of the things that I'm hearing a lot from clients, so we've obviously had this sort of supply chain issues, and then I've also heard about from clients how difficult it is to attract staff. Now, these changes to the national insurance levy are obviously going to have an impact on keeping good people and recruiting new people, because obviously even if you're paying people more, they're not necessarily going to be feeling it through the wage packet. So I think businesses will need to become more innovative in terms of how they're paying their employees. So think about possible alternatives. So paying increased pension contributions instead of additional salary. This will be more advantageous, obviously, for those that are near at retirement age, rather than those that are in their 20s, say. But, you know, obviously you get a deduction in your P&L, and obviously it's received by the individual tax-free. If they're a higher rate taxpayer, you know, obviously they'll have some significant benefits. Consider how you might reward those key individuals in your team with a capital event rather than an income tax event. So maybe look at share schemes, and I know a lot of you will have some of these in already. The EMI scheme continues to be popular, the Enterprise Management Incentive Scheme. This scheme's obviously, it's great because you can issue options to key employees that only get exercisable on sale. So effectively, you're not giving shares away, you are giving away the right to exercise those shares in the event that the business is sold at some point in the future. And obviously the benefit to the employees is that in the event that the business is sold in the future, they end up with a capital event rather than an income tax event. Now, as CGT is levied at 10% or 20%, as opposed to income tax rates of 40–45%, this is even more attractive, particularly with the introduction of the new NIC or social care levy. The discrepancy between income and capital has been the subject of a recent Office of Tax Simplification report, which was released in November 2020 ahead of the spring budget, when it was widely anticipated that there would be changes to the capital gains tax regime. The OTS made a series of recommendations, of which I think some of them you should take more seriously than others. One of the key recommendations that they made, which sent lots of hairs running, was that there was going to be an alignment between the capital gains tax rates and income tax. My feel is that that is highly unlikely, given the impact that it would have on business owners and, more importantly, Tory donors. However, it's certainly possible that there could be a bridging of the gap by incrementally changing the CGT rate, the higher rate, say from 20%, which it is at the moment, to maybe 25 and 30. The OTS report also discussed removing the perversion caused by employee share schemes, like obviously the EMI scheme that I've just mentioned. The report was very critical about the fact that as an employee, if you were to be rewarded on the business being disposed of as a bonus, you would pay more than twice as much tax as if you had received shares and been able to sell them at the date of disposal. And obviously, as I said, we do a lot of EMI schemes here, maybe as much as 30 a year. And in some instances, some of those schemes go in 12, 18 months before a disposal. And with the ability to apply a minority discount on the acquisition, and then obviously receiving a pro-rated amount of the consideration on disposal, it's easy to see how that can have a significantly advantageous effect on those employees. So far, the Treasury has ignored the OTS report, and I think that's because they've obviously been distracted by coronavirus, but they won't ignore it forever. So my feel is, if your businesses are considering putting in an EMI scheme, that actually they should think about getting on with it. If the Treasury was smart, what they'd do is they'd remove the ability to claim the minority discount on the acquisition of the options, because that would create a bit more of a level playing field. But I'm not confident enough to say that they wouldn't scrap it or replace it completely with something new. But any event, you know, if that is a consideration in your business, my thoughts are that you should accelerate getting that sorted. Finally, I'm just going to talk about a couple of IHT matters that may or may not relate to you, obviously, as SDs, but it's important to bring it up just to sort of have a general knowledge about it. And then obviously I'm going to hand over to James. If you are an FD of a family business, this might be more important, but actually it's relevant for most shareholders. Business relief, or business property relief as it was formerly known, is a relief that exempts shares in an estate for IHT purposes. And it's key, really, it's key for succession, but it's also key, let's say, where, and we've had a couple of these this year, whereby we've had maybe a number of shareholders, they're not connected in terms of family, somebody's passed away, and then the shares are being bought back by the company. Obviously, because of business relief, or the application of business relief, the value of those shares are exempted in the estate for IHT purposes. So they don't get charged the 40% IHT that everything else will get. BR has been around for a long time. And the other sort of strange thing about it is, not only is it IHT free in the estate, but you also get a CGT uplift at the date of death. So essentially the beneficiaries of the estate could sell the shares the day after inheriting them, and all the proceeds would escape tax completely. And again, there was another OTS report back in 2019, which stated that obviously this created an unfairness. And you can see why that would be, because just to sort of use an example, if you've inherited shares and they're worth £1 million and you bought those shares for 100 quid, essentially without the BR, the IHT would be £400,000. With BR, but without the tax-free uplift to market value on the sale, the CGT on the disposal of the shares would be £200,000. Without both reliefs, obviously, it would be catastrophic. I don't think that would ever happen, because obviously that'd almost go too far the other way. But in recent tax publications, there has been discussion about the tax-free uplift being abolished. Now, the reason why that might be important is if you're buying shares back into a company, then usually because they've been free in the estate and because they're CGT free, that discussion about the buyback value is usually very straightforward. But if the individual, the beneficiaries are only receiving net, then obviously that might make the discussions about what that value looks like to be more onerous potentially, or more difficult. So that's the first thing. The second thing is the way the availability of business relief is determined. So to qualify, the business needs to be wholly or mainly trading. This means in the business, the trading activities taken in the round need to be greater than 50%. This is different to the criteria that is required for business asset disposal relief, or old ER. I'm not quite sure why they keep changing these names, but for business asset disposal relief, you need to be at least 80% wholly or mainly trading. So obviously there's a big difference between being 50% or 51% and being 80%. So I have a lot of clients where they might have investment assets on the balance sheet. For example, I've got a client who is a pub and a brewery, but they also have holiday accommodation, and it's all in the same company. They qualify for business relief just. So in the event that the BR rates were aligned with business asset disposal relief, they would no longer qualify. I've also got a lot of clients that are property developers, and when the market isn't so great, instead of selling maybe what they've built, they will hold it and they will rent it out for a period of time. And again, those clients need to be careful that with business relief, if it were aligned to business asset disposal relief, they would no longer qualify again. Now, obviously, if you think about property, sometimes they might hold it, sometimes they won't, sometimes they might hold it. And over the 2-year qualifying period that you need for BR, that might go in and out. So you might be qualifying one day, not the next, and then the following day, you need to qualify again for a 2-year window. So it might be beneficial when we have the relief to maybe do a review of the balance sheet and understand where the company is in terms of business relief, and just make sure that that you're comfortable within that in the event that the rate should change. If you're not, you might want to try and bank business relief now. So that's the end of my chat. I'm going to hand over to James now.
So Lisa talked before about the increase in personal rates. Obviously, I'm just going to give a bit of an update on something you've already probably heard about, being the increase in the corporation tax rates that are coming in April 23. And it all sounds very simple, being that there's going to be a 25% rate for profits over £250,000. The problem is that, as well as that, there is a bit of new rules coming in about how we calculate that where there's a group. Up until now, a group constituted for corporation tax purposes is purely a traditional corporate group as per the definition in the Companies Act, and that is if you have any 51% subsidiaries. Come April 23, that changes, and it changes to everything under common control of the shareholders if they are related in some way. That's a very simple definition, and that could bring companies that previously had profits under £250,000. It's a worldwide basis, so if there's any companies overseas held by the shareholders personally, you're going to have to take those into account when assessing whether the £250,000 limit is breached. Because obviously, if there's more than one company, if there's 2 companies, that limit is 250,000 divided by 2. So that is a bit of an issue going forwards, and that needs modelling if you think you've got companies that fall within that definition. It's not just your own corporate group. So we've talked about the associated companies rules and how that may impact. But again, if you've got a smaller company, it's not just a straight 25% over £250,000. This comes in, effectively changes get transitioned in for profits over £50,000, because up until that, if you've got one standalone company with just one shareholder, say, then if his profits are £49,000, his tax rate will stay at 19%. Once you get from 50, transitioning to £250,000, you're into what's known as a marginal rate, and the rate of tax, the effective rate of tax on profits within that band is going to be 26.5%. So if you fall within that, going forward, then things to look at prior to the year end, pension contributions, because you're getting relief at a higher rate there, and bonuses as well if they're going to reduce the profits. Coming up to April 23, obviously the rates go up then. If you've got a March year end, you need to consider revenue recognition. And by that, I mean, we can't artificially bring forward income, but in the run up to that sort of deadline date, if you've got any large transactions that are going to be completing, sales of capital assets, big contracts that are being agreed, then just consider that as can we reasonably recognise that revenue in your March 31st of March 23 year end, because you're going to lock in that 19% rate then. One last point on this definition of associated companies. It includes all active companies, and by active I mean companies carrying on either a trading activity or some form of investment business. There is an exemption for dormant companies or holding companies where it is merely just a dormant holding company where, say, a dividend goes through it at the year end and it's paid out in full to shareholders. That's known as a pass-through company, and that isn't counted when you're talking about the number of associated companies rules. So in addition to this increase in rates, think about if you've got profits at the moment above 1.5 million, and again, that's reduced for the number of companies in your group at the moment, that quarterly instalment regime is also going to be impacted by this new associated companies, because that £1.5 million limit at which you start paying your corporation tax in instalments rather than 9 months after the year end, that's still in place. But if you have 3 companies, then anything over £500,000, you go in the instalment regime, and you need to be looking at that in 2023 if you're already in the regime, because later in that year you're going to have to start calculating your corporation tax with the new 25% rate in there. So there's some pretty complex modelling here if you think you're going to be having large profits in that year, and that tax may come sooner, and it also may be higher than you're used to. Because if you think about it, 19% to 25%, that represents a 31% increase in the actual tax rate. And if there's some hefty corporation tax bills, that is nearly a third of a nearly 33% jump, which you're going to have to factor into your cash flow modelling for the years ahead. You do the next slide, please, Lisa. So the bad news, obviously, is that tax hike in April 23, but last March, the Chancellor gave you a bit of an incentive in this sort of 2-year period before that, now looking at 18 months. And again, you've probably heard of this, the super deduction, the 130% allowances for CapEx on plant and machinery that's going to be in place till the 31st of March 23. All well and good, if you've got some large CapEx planned, then you're going to get that deduction. What's generally sort of not bandied about too much, though, is that you don't get that for hire plants. So if you've got any hire plant businesses where you let assets out to customers on leases, you're not going to get the super deduction. You may get it if those assets are hired out as part of a service. So if you carry out a service contract for someone, you may be able to get it on that. If you buy stuff on HP, that's okay, as long as the goods are delivered prior to the 31st of March 23. If not, you'll only get it on the deposit that you've paid. Finance lease or pure hire assets, you're not going to get it. Now, thinking about what you're going to be spending money on until March 23, the budget last week announced that before the super deduction came in, you always got 100% relief on your CapEx on plant and machinery up to £1 million. And that was due to go down to £200,000 from the 1st of January. Now, you're probably thinking, well, that doesn't matter now because we're getting 130% on everything up until March 23. But where it interacts is that, say you've got a building project, or you're buying a new building or refurbishing one or building an extension, part of the fixtures in that building have always qualified for capital allowances, but some of them won't qualify for super deduction. And it's things like the M&E systems, lighting, heating, which can add up to quite a big proportion of a construction spend. Now, the extension of the £1 million annual investment allowance till March 23, that keeps in place your first £1 million on expenditure on stuff like that. You're still going to get 100%. So if you've got any building projects, extensions like that are in the plans, have a think about when you might be contracting for them to happen and getting some of that expenditure in before the 31st of March 23, because especially on stuff like the M&E, elements of that, if that expenditure goes forward past March 23, you're only going to be getting 6% per annum on that over and above £200,000 if the annual investment allowance goes back down to that. So bringing some of that expenditure forward may be tax efficient. Obviously, don't let tax considerations make you do something earlier than you should do on a commercial basis, but it is something definitely to think about if you are thinking about extending or acquiring new building assets. Yeah, next slide, please, Lisa. So again, one of the biggest changes last week, and I appreciate not all of you are involved in this sector, and you're probably thinking residential developer tax, that's for the likes of Persimmon, you know, it applies to group profits over 25 million at the rate of 4%. I mention it though, because where you have developers who have JV projects, this brings their share of any JV projects where they hold more than a 10% shareholding. If you're getting more than £25 million profits on residential development activities, then it's on that group-wide basis plus JVs. And crucially, there is no, when you're calculating whether this 4% surcharge, which that's what it effectively is, you know, you're going to be paying, residential developers will be paying 25% corporation tax on profits above 250k. But when they're calculating whether this 4% surcharge applies, there is no deduction for finance costs. And that was explicit in legislation that came out last week. So you could have mid-range developers who in a good year might be bumping up against that limit because in their mind the profits might be a lot less than that because of the finance charges. But there's no deduction for finance charges, no deduction for losses either, for losses brought forward. So it's very much a surcharge on gross profits when it comes to residential. And the definition of residential, it's quite detailed in legislation. It's not just building houses. It includes gaining residential permission on land owned by the group, as well as actual developments. So land traders, if you're dealing in land, getting permission on it, selling it on, that will all be included in the assessment of whether you breach this £25 million allowance. One of the big fears about this when the consultation was first announced is that build to rent and construction of investment type properties would be included with the regime, but thankfully it wasn't. So if you've got residential development where you're building it for rental purposes, that is excluded, and therefore that will just still continue to be treated in the same way and taxed at the same standard corporation tax rates. Yeah, next slide, please, Lisa. So we talked before about the impact of the associated companies and groups on the main corporation tax rate. Now here I am saying former group. Why am I saying that? Because trading through a standalone limited company at the moment is closing off a pretty big opportunity for a valuable tax relief going forward. The tax relief is the substantial shareholders exemption, which has been in nearly 20 years now, but it's been reformed a bit in the last 2 or 3 years, and it is really valuable when you're thinking about selling part of the business or indeed the whole business via a corporate sale. Why am I saying former group? Well, even if you just form a dormant subsidiary, you know, and the example usually given is you can protect a trade name, have that company as a dormant subsidiary. It won't affect your corporation tax instalment regime or the application of the marginal relief on the 250k. What that does though, after that's been in place for a year, that means that should someone come along in the future and say, I want part of your business, you could transfer that part of the business as a going concern down to a newly incorporated subsidiary and sell the shares in that subsidiary. And you can do that on a corporation tax-free basis. That money comes into the existing company and there's no corporation tax on it due to the SSE, substantial shareholders exemption from corporation tax. There was a recent case earlier this year that confirmed that this relief is definitely not available where you tried to do that just before a sale and you've only got one standalone company in existence. And that means that forming a group is just good housekeeping to get that 12-month timeline ticking so that you can take advantage of that. The other thing to note on that is it's not just about selling part of your business, because obviously the traditional way of a family company or an entrepreneur who's formed a company to exit is to sell his shares personally and access the first £1 million at 10% capital gains tax rates. If you've got a company or a group of companies where the shareholders are anticipating a sale in excess of what they think they will need personally, and they're looking at either doing further projects, investing in further projects in terms of deals or starting new businesses, this SSE exemption works really well, because one thing you can look at is putting some of the shares into a family investment company or a trust, and therefore diverting some of these sale proceeds on an exit into that corporate vehicle and not paying any tax on it, and still accessing some of your personal tax rates. That's a bit more complex planning, but having this group structure in place does allow you to access that and think about that. And as businesses become more mature and you're thinking about exits, it is definitely worth seeing whether that is applicable to the shareholder and his family requirements. It's an interaction of their personal wealth profile and what the company is doing itself. We've done a couple of these type of structures where it's worked pretty well. Part of the business has gone, and we've been able to the company itself has been able to access those proceeds tax-free, repay a load of bank debt, and carry on trading with the remainder parts of the business. So I think that's me done, Lisa. Unless anybody got any questions, then feed them through Rob, and we'll be available afterwards.
For those of you who don't know me, and there's probably a lot of people on the call who don't, I'm fairly new to Cowgills. My name's Gemma and I'm a director in the VAT team here. My bit obviously is going to be talking about VAT and what's happened recently. Can you flick on to the next slide, please? So in the budget, and I had a bit of a meltdown before. I thought, is it a budget or is it an autumn statement or is it a something else statement? But it was, isn't it? It's autumn budget. So I think I managed to slip under the radar on that one. So I didn't want to constantly talk about Brexit because I think everyone's really bored about it. But from an indirect tax point of view, Brexit is literally the biggest thing that has ever happened since the introduction of the tax in 1973. It's got, obviously, it's bad sides, and we all know about that. But the one of the positives that Brexit's brought us is it means that we can deviate from those overarching EU legislation and the EU directive that we've been bringing our rules in from since the early 70s. So Brexit has meant that we now have an opportunity for the UK to set its own VAT rules. So we could then say, right, from tomorrow, we're changing the VAT rate for, construction on or residential conversions or something like that. We're going to take it from 5% down to 0 rate. We could do that at any point going forwards. And there's been a lot of criticism from indirect tax groups that the government just aren't doing enough. So we've got the opportunity to set our own VAT rules and make changes where we want to see them, but they're just not making the most of those opportunities. So examples are reducing the rate of VAT on domestic fuel. So we've all seen what's been happening in the press with the suppliers, and we've seen that the most vulnerable people in our communities are going to be impacted most by the price rate rises. The government could have brought in a temporary relief and said, right, we're going to change it from 5% down to 0 to help people a bit with their cash flow. They haven't done any of that. Obviously, there's also in the development sector, for years we've been pushing for some harmonisation in the VAT rules to say, it's unfair that property developers get more favourable rules than, say, for example, someone who is building their own house to live in. So we've asked for harmonisation in those rules, and the government could put these into place now because of Brexit, but are failing to do so. Coming back to the budget, really, we weren't expecting any major changes. 2021 has been a bit of a car crash for that. And everyone knows that the impact of Brexit has been absolutely far wide-ranging and has been massive on all aspects of all organisations, really. We've also had a new phase of MTD being brought in, and that's been really laborious for some businesses to try and get compliant. HMRC are now saying we're going to start giving penalties for people who aren't complying with MTD. So that's putting more pressure on businesses at a time when actually the resource is stretched anyway. And Lisa touched on it before, we're struggling to get, you know, good quality people or retain good quality people. So that is flowing down into the sort of the doers roles in the VAT returns. You know, things are getting missed because new people are coming in, things like that. So that's stretching us. Obviously, we've also had the introduction of the domestic reverse charge for construction services. So that's been had a real impact as well. And it's not on the, you know, James was talking about before about how it's the big boys, all these rules are supposed to catch. Actually, it isn't. It funnels down, and it's the subcontractors that are really in the worst position on the domestic reverse charge. It's those people who are likely to be getting the rules wrong. So they're the ones who are probably liable for penalties and things like that. So it's been a bit of a hectic year, and we weren't expecting anything in the budget. And I don't think we really got anything meaty either. Next slide, please. So I'm going to just look at now a couple of changes that were announced. Some of them were announced in the budget, and also some of them have already been pre-announced, but obviously just to make you aware of these. The VAT threshold is going to be maintained until at the earliest 2024. So that means the VAT registration threshold, which is £85,000 of VATable turnover, and also the VAT deregistration threshold, which is £83,000 of VATable turnover. Now, HMRC talk about this cliff edge of businesses. So in their minds, they think there's a raft of businesses that work up to the £85,000 VAT registration limit and then don't do anything. They go on a cruise from, you know, February to March and don't do any work. The reality is that that's not, you know, that's not realistic, and that's not what happens in practice. HMRC are always talking about, are we going to change that threshold? Are we going to make it a nil threshold or make it really small, like £10,000, for example, or pushing it the other way and making it really, really big so that there's, you know, a bigger band of people who can be entrepreneurial without having to, you know, being caught by the VAT rules. But at the time of writing, we're not expecting any changes until a couple of years' time. Those of you who sell goods will be aware of the plastic packaging tax that's coming in from 2022, and that's for certain types of plastic which is non-recyclable. So that's something to look out for if you use a lot of that or you sell it. The next big thing is there's been a bit of a, or there will be a bit of a shake-up in the VAT surcharge regime. So there's the taxpayers are disgruntled with the VAT surcharge regime because it's plainly unfair. So if you're 1 day late with your VAT return, you'll get a penalty that can be up to 15% of the VAT that was due. It's not in line with other taxes where, you know, if you submit your tax return, like your personal tax return 1 day late, you get a fine of 100. It just doesn't seem fair. So there's been some consultation, and then there's been some guidance put out about how the VAT surcharge regime is going to work, and that's coming in from next year. So it should bring penalties down, and it's based on it's based on risk, and also how compliant that you are with the rules. So the more you get in trouble, the bigger your penalty will be, which seems more fair, and I think people would appreciate that across the board. The environmental groups have gone mental about the reductions in air passenger duty. So domestic flights, they're reducing the air passenger duty down to about half. So obviously that, you know, we've all seen that in the news about COP this year and what's happening environmentally. So they're pushing forward and saying, you know, we should be putting those rates up and encouraging people to use more energy efficient and environmental ways of traveling, rather than saying making it cheaper to fly. The one you've all been waiting for, we've had a reduction in excise duty for some alcoholic beverages. So I'm going to spend 55 minutes now telling you exactly how your beer is going to get cheaper. No, but joking aside, this is probably one thing where it's a bit of a baffling decision that was made. So from February 23, so don't go on your booze run just yet, they're simplifying taxes on and duty on alcoholic beverages. They've frozen duties for now, so you'll remember year in, year out, they say we're going to increase duty on alcohol, we're going to increase duty on cigarettes and fuel and other things. They've said we're going to keep that steady for now, and in the future, so from Feb 23, the way they tax alcohol is going to be based on the ABV, so the alcohol, the volume in your drink. So for your £8.50 bottle of Prosecco, your tax is going to go down by 87p. So that's quite a significant chunk. Those of you who are less classy than us and drink Guinness or Stella, a pint of that's going to go down by 3p. So the duty on that is going to come down, but not as significantly. There's been no change on the sugar tax either. So that was something that the government brought in, trying to make us all eat and drink better. And I'm not sure that has made any impact whatsoever, other than making you more difficult for a restaurant to sell you a pint of Coke rather than a pint of Diet Coke. So quickly now, if we just flick onto the next slide, please. What are we seeing in practice? So we've had huge changes. And in the indirect tax world, what are we seeing, day to day, what our businesses and our clients coming to us and talking to us about? So going back to Lisa's brilliant description before about the supermassive black hole, HMRC are back in business. There's something like an £9.8 billion VAT gap. So that's the amount of VAT that they theoretically should be collected and the amount of VAT that they actually do collect. So that's obviously, if we take out last year where everyone was allowed a deferment on their VAT for the March to June quarter, if we take that year out, the amount has increased slightly from 18-19. So HMRC are looking at that and saying, right, there's something we need to do here. We need to do things there. One of the ways they're doing that is they're doing more visits and inquiries. So because they've got used to this, we can work from the office, we can work from anywhere rather than having to visit businesses in person. They're opening more inquiries. They're saying, right, I want to look at what you're doing. I want you to send me the paperwork, send me the invoices, prove to me that you are doing what you're saying you're doing and that you're entitled to some VAT relief. So we're seeing a lot more of that now, and they're being less lenient as well. So there's an end to this light touch, and we're helping businesses get through COVID. It's now, you've made mistakes, you've been doing it for a year, no longer a slap on the wrist, it's penalties, and then they're going for the higher level of penalties as well. So they're not saying 15, 10, 5%, they're going for 30 with a view to reducing that down from there. So if you are making, or if you know that you've made mistakes, now is the time to fess up and do something about that and make sure that you can mitigate any charges. As with all of these things, HMRC focus on those high risk sectors. So they're the ones where they have a bee in their bonnet about them because they think that everyone is interpreting the rules incorrectly or that there's some fraud there. Land and property, because it's so complicated from a VAT point of view, is always up on that list. So businesses that do land and property development, they sell parcels of land, are always, I suppose, disproportionately affected by anything HMRC do, because the risk there for getting it wrong is so high. We also see it with things like scrap metal dealers and recycling businesses. So HMRC think that there's a lot of fraud in the supply chain there. So they tend to go after the bigger players in the market who are unwittingly and don't know that there's fraud in their supply chain, but they chase the fraud up to the person who is still in business and is still able to pay penalties. So if you are in any of those high risk sectors, just make sure you understand what you're doing and take advice as soon as you can if there's something a bit different that you're doing recently. Next slide, please. So at the risk of being a bit of a downer for everyone, we see errors and things going wrong in indirect tax all the time. Everyone on this call would probably agree that VAT is not a straightforward tax, it's incredibly complicated. But we're constantly seeing people making the same mistake on these easy wins, which is really frustrating from an advisor's point of view. So things that we're seeing where it can go wrong specifically in the last sort of 6 to 12 months is businesses not complying with phase 2 of MTD. So making tax digital came in a couple of years ago, and we've just recently had a new phase of that, which means that you need to have digital links between each of your different software. So HMRC have now said that they've given people enough time, so they're going to start penalising businesses who aren't complying with the rules or are making no effort to comply with the rules. So we're expecting penalties to start coming thick and fast. We've had 6-9 months to get into this now, so HMRC are going to start looking at this heavily. Brexit, I said before, I didn't really want to focus on it, but there's more changes that are coming in from early 2022 regarding paperwork. So HMRC said at the start when we left the EU, they'd give us a period of grace to get our paperwork in order before they started looking at it and making sure that the goods can leave the port, for example. From 2022, your paperwork all needs to be in order before they'll let the goods leave the port or wherever it is they've entered the UK. So this means, Lisa touched on it before, this means even more backlogs at the ports. It means even more bureaucracy, red tape, making sure things are going smoothly. Are you absolutely sure that your paperwork is up to date and your goods aren't going to get stopped? If you're operating in an environment where you need those goods at the time that you've ordered them, you need them straight away. You're not holding stock. Make sure that all your processes are up to speed and in the right place, and that you're prepared for those changes next year. Another big one is, again, I touched on it before, the domestic reverse charge for construction services. We're still seeing a lot of businesses who aren't complying, and the reason why is that they go through the flowchart from HMRC and say, oh, I'm not compliant, I don't need to abide by these rules because, for example, I'm not CIS registered. When actually the question then turns to be, should you be CIS registered? And we've had a couple of businesses that have been merrily going along and not realising that they should be within the scheme, and actually then it flips them into being required to operate under the domestic reverse charge as well. So if you are in business in property and construction, I would ask you to, again, go and look at the criteria and just satisfy yourself that you don't need to apply the rules there. And the usual easy wins for HMRC when they do a visit, business and staff entertainment. So you might have trailed off a bit with entertaining in the past 12 months, but you might be ramping it up again now towards Christmas maybe. You might be having some festive drinks and things like that. Make sure you're getting the VAT treatment right on that. The easy wins, they come in and say, who have you invited to your Christmas party? Right, you've had staff and partners, therefore there should be a VAT reduction on your input tax there. Vehicles is always a good one as well. HMRC will come in and people, the rules are complicated, so people don't understand when is it a commercial vehicle, when is it a car, so the rules can be complicated there. And bad debt relief as well. This is a massive area. So every business I expect will have had some issues with bad debt over the past 12-18 months. Make sure that you're getting the bad debt relief that you're entitled to. The flip side of it is if that you've not made payments to your suppliers, you need to make sure that you give that input tax back to HMRC after 6 months after the invoice became due. So that there's a give and take there on the bad debt relief rules, and you just need to make sure you're applying it correctly. One way that we see clients that's really popular is we do health checks. So we can go out and do a mock HMRC visit. So we can go out and look at the systems, look at the procedures, tell you whether you're complying with MTD, look at your Brexit, look at your Incoterms and say, have you got any areas of risk there, or have you got any obligations that you didn't know that you had. It's a good way to understand the risk profile of the business, especially if you're new into the role, or you've had a change in personnel. Make sure that things are happening the way that they should be. And I think that might be me. I'll just be quick because I know I'm conscious of time. Where particular care needs to be taken. So James mentioned this before. So there's a lot of instances where you might hold property with a view to converting it and then selling it on. The market might frustrate your original intention, and you say, oh, well, actually, I'm going to keep hold of the property now and let it out. That's a real massive red flag for that. So anytime that you had an original intention and you change that for whatever reason, please take that advice before you do that. It can make the difference in having a zero rated supply of the grant of a major interest. So you could have built some dwellings or converted an office into dwellings, and now you were going to sell it and now you're going to let it out. That'd mean that it goes from a position where you could have recovered all of your VAT to a position where you can't recover any. So you need to understand what are the cost implications of your change of intention. Diversifying your activities. Have you considered the VAT implications of that? If you thought about, right, well, I was using my building as an office for a taxable side of the business, and now I'm going to use it to sell insurance from it. Well, that's an exempt supply, so you'd have an impact on the cost recovery of the building. Capital goods scheme and other adjustments. These are easy wins for HMRC. Again, if you've changed the use of a building that you've paid over £250,000 for, you need to consider the VAT implications of that. We find these issues when people come to sell the building that they haven't they haven't applied the capital goods scheme going backwards, and it can give them a massive headache and also cost them a significant amount of money to get it fixed before the new buyer comes in. So that's just something to understand. And an area which is particularly complex is residential conversions. Please don't get caught out. Take advice really early during the planning stages, and as things change and diversify and as your planning comes through, you know, like I say, just take the advice on that and just make sure that you understand the implications and what you're doing and what your budget is, because you might not have budgeted to have a chunk of that added at the end of the sale. So just make sure you know what you're doing. So I think that doesn't leave us very much time for questions, but if Rob, if you want to open it up to the...
I've been monitoring the chat function. I think there's been a lot of detail in there, Gemma. There's no immediate questions that have come through, but I think the most important thing is that we're going to send the slides to everybody involved after the event. We'll make sure that Lisa, James and Gemma's contact details are on there as well. So clearly, if you have any questions, once you've digested those slides, again, if there are any immediate questions that come through, obviously, you know, feel free to ask. I think the conversations that we've had internally, Lisa, I think it was at the partners meeting, which it might just be worth you touching on, is, I guess, due to COVID particularly, that HMRC, the feeling is that they are clamping down and being much, much more stringent than they have been previously. Is it worth just touching on that?
Only to the extent that obviously a lot of resources were diverted when COVID first hit. So, you know, resources were moved to things like time to pay arrangements, and also some of the sort of COVID measures like furlough. Now all that has stopped. What we're seeing now is HMRC, you know, reverting those resources back, particularly. You know, there are some very low-hanging fruit in terms of furlough fraud that HMRC are picking up, seeing that an awful lot of activity there. And then generally just getting back to business. So there was, I can't remember receiving an inquiry during COVID, but now we've had a flurry of activity since obviously people have returned to work. So I think it's things like that, just making sure that when we were in a point of crisis, it's not, you know, it's understandable that people may have made mistakes, but now HMRC are very much back in business, as Gemma said, and they're doing more visits now. So they will be picking up, you know, errors and charging for them. Again, you know, to come back to my supermassive black hole, there will be lots of measures that they will be driving to try and fill that. So we've obviously got the NIC changes, we've got the dividend tax, we've got the social levy. All of that really is about is very focused spending, but we've still got lots of other things that they'll be looking, particularly on the tax gap, where HMRC would be looking to recover. And because of the situation we're in, you know, they're not going to be sentimental, or when it comes to talking about penalties, they're gonna hammer them.
Just Lisa, just a real life example of that is the revenue. We've got a particular focus now on looking into R&D claims and crucially delaying payments of the R&D tax credits, and that is something that, because of what can only be described as probably fraud on some claims going in, the revenue are really taking a close look at all R&D claims now. That is something to be aware of. If you're reliant on an R&D tax credit, it's probably going to be delayed at the very least, and there's a lot more inquiries coming down the road.
I mean, generally as well, dealing with HMRC has become even more painful than it was previously, if that is even imaginable. You know, it is a case of, if you're planning to do something, so we've had a real backlog in terms of clearances, and, you know, just trying to get hold of somebody, A, who knows what they're doing, or B, who comes back to you, it's just frustratingly difficult. So if you are planning to do anything, or if there are, you know, if you are making claims to HMRC, the sooner you get that in, the better, really.
Great. Okay, guys, just conscious of time. I think we've gone past 9:30. So thanks very much to everybody. Hope it's been really useful. Thanks for dialing in. We'll make sure that the slides and contact details are distributed, and please get in touch, and we'd be delighted to help, and we'll see you at the next event.
Okay. Thank you, everyone.
Take care, guys.
Bye. Bye.